Okay, let's unpack this. We talk constantly, sometimes breathlessly, about the explosive growth and this seemingly unstoppable momentum of artificial intelligence. It feels like it's everywhere. The engine driving global markets, yeah. The focus of like all the capital investment, and really, it seems like the foundational layer for well, for everything next. But what if that engine hits, massive turbulence? What if there are serious structural headwinds? Things like physical constraints, politics, finance, stuff that could slow it all down, maybe even delay or temporarily derail the whole AI revolution. That is exactly what we're diving into today. This is a really fascinating discussion where we isolate four major threats to AI development, and we're drawing heavily on some sharp analysis from market strategist Mookie Tenenbaum. Our aim, to understand not just what these threats are, but crucially, how serious Mookie Tenenbaum actually thinks they are for the tech and maybe more importantly, what it means for you, the investor right now. Think of this deep dive as a necessary shortcut, moving past the general hype, focusing squarely on the complex reality, the challenges that experts are really grappling with.
Yeah, and what's really interesting here is Mookie Tenenbaum makes this point very clearly. These four threats, they're not just his personal worries or some kind of fringe theory. No, they represent the consensus risks, the things widely perceived among top market experts, institutional investors, the big players. So we're going to examine each one, really get into it. We'll contrast that perceived threat level with his own specific data-driven observations and, frankly, some pretty robust rebuttals he offers. But maybe first, to really set the stage, we need to grasp this core paradox. It kind of underpins a lot of these challenges, and it's a theme we'll probably weave through the whole conversation. See, the original promise of AI, or at least the narrative, was about democratizing knowledge, right? Popularizing high-level tech for everyone, everywhere.
Right, making it accessible.
Exactly. Yet, Mookie Tenenbaum points out that AI development is, paradoxically, incredibly concentrated. It's concentrated in the hands of just a few massive companies, concentrated in the specific raw materials needed, concentrated in its very high-end, complex supply chain.
So, like the opposite of democratized in its creation.
Precisely. Whether you're talking rare earth materials or these super sophisticated chip manufacturing, or even just the underlying capital reserves needed, this high degree of concentration, that's the basis for so many of the threats we're about to discuss.
Yeah.
Like, if you have all your eggs in just a handful of very specialized, very expensive baskets, well, those baskets become extremely high-value targets.
Targets for what?
Geopolitics.
Yeah, geopolitical maneuvering, absolutely. But also just, random catastrophic events, natural disasters, things like that.
Okay, let's start right there, Hen. With that first headwind, Mookie Tenenbaum identifies the possibility of weakened supply chains. This feels like the most tangible one, the physical risk. It often boils down to who controls the actual dirt, the minerals, and the specialized machinery needed. And the immediate concern, the one that made headlines recently, centered on China threatening to stop exporting rare earths. Now, for those of us not in material science daily, why does this matter so much, specifically for AI, not just general electronics? Right, it's a fair question because rare earths are used broadly, but they are absolutely vital mineral elements, a group of 17 chemically similar elements. Their unique magnetic and conductive properties make them essential in advanced tech. For AI specifically, they are basically non-negotiable.
Non-negotiable for what part?
For producing the high-performance microchips. Specifically, the GPUs, the graphics processing units, these are the workhorses, right? They do the heavy lifting, the parallel processing that enables training and running these huge, large language models. So, simply put, if you can't get the specialized raw material, you can't manufacture the processing power you need for the next generation of AI. It's a fundamental bottleneck.
Okay, so it hits right at the core hardware.
Directly. And the current analysis, including what Tenenbaum highlights, shows why this becomes a Chinese leverage point. China currently controls the processing of about 70% of the world's known rare earth deposits. 70%.
70. Wow, that's huge dominance. Is it permanent?
Well, Tenenbaum and others are quick to note it's not a permanent geological monopoly. There are significant deposits elsewhere, Australia, Brazil, there's exploration in Argentina and North America, but their current processing dominance is the key factor right now. It's significant. So when China even hinted at restricting these exports, just the threat itself sent shockwaves through the global tech manufacturing base.
Right. I remember the markets reacting instantly.
Exactly. It perfectly illustrates the market's extreme sensitivity to this concentration risk. One country controls the processing for a vital input.
But hang on, stepping back a bit, doesn't this sound like standard geopolitical risk? It affects lots of advanced industries, right? We had the Suez Canal blockage, trade wars.
Yeah.
Why is the supply chain threat supposedly uniquely devastating for AI right now?
That's a really critical distinction Mookie Tenenbaum makes. And yeah, if we connect the dots, the threat isn't just rare earths for the chips themselves. It extends to all the essential super high purity components needed for the manufacturing process. Think about things like noble gases, neon, argon. They're crucial for the lasers used in what's called EUV lithography, extreme ultraviolet. That's a cutting-edge technique needed to etch these incredibly tiny circuits onto the most advanced chips. And much of the world's high-purity noble gas supply. It's processed in very specific facilities, often in Japan. Companies like Tokyo Electron are key players. Or you have other essential elements, chemicals, manufactured almost exclusively in South Korea or Japan.
So it's not just one material, it's a whole chain of specialized, geographically vulnerable points.
Exactly. The supply chain for a modern top-tier GPU isn't just specialized, it's geographically fractured.
Mm.
It's extraordinarily fragile. One earthquake in the wrong place.
Okay, fragile supply chain. But still, why is AI uniquely vulnerable compared to, say, car manufacturing or phones?
It comes down to expectations. This is Mookie Tenenbaum's specific argument. AI is currently viewed, rightly or wrongly, as the absolute center of human development. It's attracting massive, almost unprecedented levels of investment. And among investors, there's this near 100% certainty of delivery. Like it has to work, and soon.
A huge weight of expectation.
Immense. So any significant, unexpected delay, even just a year or two, may be caused by a major supply chain break, a trade restriction, or like I said, a natural disaster, a big earthquake in Japan or Taiwan. That kind of delay isn't just an inconvenience. It's potentially a catastrophic blow to market sentiment for an industry already accused sometimes of being a bubble.
So it's a bubble of expectation, potentially, not just valuation. Is that where this phrase capital vacuum cleaner comes in? I think Tenenbaum used that.
Precisely. Mookie Tenenbaum uses that striking phrase, capital vacuum cleaner, because AI is currently sucking up an astonishing amount of global capital investment. Some estimates put it near 40%.
40% of all global investment.
It's a staggering figure. And this isn't just companies using their own R&D budgets. This is capital being pulled from other potentially productive sectors, infrastructure, green energy, healthcare, you name it. It's being funneled into the AI ecosystem, all driven by this promise of rapid, almost guaranteed returns.
Okay, I see the vulnerability now.
Right. So if an industry that has absorbed nearly half the world's available investment capital suddenly faces a, say, 2-year delay,
Yeah.
the instability is massive. It creates a market scenario where that delay just isn't priced in. Unlike, more mature sectors that have built-in buffers for cycles or supply issues. Yeah. The moment China threatened those export restrictions, the immediate panic, the stock price drops. It just showed how thin the margin for error is in this incredibly expectant industry.
That completely reframes it. It's not just the risk of a broken supply chain. It's the risk of breaking a global expectation that's carrying almost half the world's investment.
Wow. And that reliance on just a few physical manufacturing points, it perfectly illustrates that paradox you mentioned earlier. This supposedly democratizing tech relies on such a concentrated, fragile supply. Okay, this inherent fragility leads us perfectly into the second major threat, geopolitics. This is often the most dramatic risk people talk about, usually centered on one big, scary potential event. Mookie Tenenbaum seems to divide this into two main areas. The external threat, which inevitably means China and Taiwan, and then maybe internal conflicts within the West, US-EU friction, Japan getting involved, that sort of thing.
Yeah, and this is where Mookie Tenenbaum offers a really strong, quite specific counter-narrative, especially on the most feared geopolitical risk, that potential Chinese invasion of Taiwan. He takes a remarkably strong stance here. It's quite counter to the prevailing media narrative.
Okay, so what is his specific view? He doesn't think it'll happen. He's very clear. He believes a full-scale Chinese invasion of Taiwan will not occur. I think his phrase was something like, no chance that will happen.
No chance. Wow, that flies directly in the face of, well, pretty much constant headlines and military analysis suggesting it's a major risk. What's his rationale? How can he be so confident?
His reasoning is very pragmatic, very detailed. He focuses on 3 key elements as he lays it out. First, logistics. China, right now, simply lacks the necessary immediate capability for a successful amphibious invasion of that scale. Transporting and supplying potentially millions of soldiers across the Taiwan Strait. It's an immense organizational challenge they haven't shown they can master yet.
Okay, so the physical capability isn't quite there. What else?
Second, Taiwan's own defense. Their forces are far better equipped and trained than often perceived, especially for defensive land warfare. They have strong anti-accessoria denial strategies. China knows this wouldn't be quick or easy. It would likely be protracted, bloody, devastating combat.
Makes sense. Better defense than usually credited. What's the third point?
The third, and he argues this is the most crucial, is the global strategic calculation, specifically the U.S. and the West. He argues they would view allowing a successful Chinese invasion, which critically means allowing China to gain control over TSMC, the world's most advanced and important chip manufacturer, as absolute suicide. Strategic suicide.
Suicide because it hands over the keys to future tech.
Exactly.
Oh.
The economic and strategic fallout of letting Beijing dictate the pace of global technological development, which TSMC largely controls right now, it's just too dire. It would fundamentally collapse the existing technological and military balance of power. He believes the consequence is simply too high for the West to allow it, making significant intervention virtually certain.
Okay, so the logic is invasion is logistically hard, Taiwan can defend better than thought, and the West cannot afford to let it happen because of TSMC. That's a compelling case against it. But what about the market then? Because, I mean, TSMC's stock value has been depressed by this narrative, hasn't it? It trades lower than other comparable tech giants.
Precisely. And here's where Tenenbaum highlights this fascinating disconnect between the constant market fear and what he sees as the underlying reality. While the threat is constantly discussed, it's on the agenda, it's real enough to lower stock values, especially for TSMC, which, despite being the world's 9th largest company, trades lower. Mookie Tenenbaum argues this expectation, this risk, is already priced in, heavily.
How heavily?
Some analysts, and Tenenbaum seems to agree, suggest TSMC is effectively paying a staggering 35% geopolitical insurance premium on its stock price.
Yeah.
Purely because of the perceived Taiwan invasion threat.
35% just for that risk. That's an enormous discount.
It's huge, right? And that's Mookie Tenenbaum's core point for you, the investor. The market has already factored in a massive safety margin for this specific risk. Therefore, the real risk isn't necessarily that a full-scale invasion might happen, which, again, he discounts heavily. The more likely risk is some new military action short of a full invasion. Maybe a naval blockade, maybe a significant air incursion, something that spooks the market and causes a short-term price dip.
But not an existential threat to the company or the industry, in his view.
Not in the long term. He argues that major long-term investors, huge players like Google, BlackRock, JP Morgan, they understand the full invasion is highly unlikely. They know the risk premium is already there. So if the market panics on some lesser event, they'll likely be there, cash ready, to buy those shares at an even cheaper price. It becomes a volatility risk, a buying opportunity for the long-term holder, not a fundamental solvency risk for TSMC or AI.
That's such a critical reminder for listeners. Markets often react, sometimes wildly, to the expectation or the fear of an event, not necessarily the event's actual long-term impact. We need to try and separate the short-term panic from the underlying reality. Okay, before we move off geopolitics, you mentioned Tenenbaum also touches on internal Western conflicts, like US-EU squabbles. Are those seen as serious threats?
He addresses them, but views them as much less critical to the core AI trajectory. We're talking about things like governmental instability, maybe unexpected election results, shifting policy, or major US-EU disputes over trade rules or tech standards. These are inherently unpredictable, right? Because the information driving them isn't transparent, like, say, a chip development roadmap. Politics is messy. However, in Tenenbaum's view, these internal friction points, while annoying, are not serious threats to the continuation of AI development over the next few years.
So they might cause some headaches, some delays, but not stop the train.
Pretty much. They might cause friction, generate lots of paperwork, maybe spark minor trade skirmishes, but they won't fundamentally halt the underlying technological momentum, which is still heavily centered in North America, particularly the U.S.
Got it. Okay, let's shift gears completely now. Away from physical supply and military threats, let's talk markets. This is the third threat Mookie Tenenbaum outlines: financial instability. And given the absolute staggering valuations we've seen lately, I mean, NVIDIA recently becoming the second most valuable company globally, second only to gold in market cap, it's mind-blowing. It naturally raises the question, how much of this explosive growth is just froth? Is it fueled by structural debt, excessive leverage? Are we setting ourselves up for another big bubble bursting like we've seen before?
Yeah, that fear of a financial bubble ready to pop is entirely legitimate, especially those kinds of numbers. But here again, Mookie Tenenbaum provides some really crucial context. He carefully separates corporate risk from investor risk, which helps moderate that anxiety quite a bit. The details really matter here.
Okay, break that down. Corporate risk first.
Right. Let's look at how the companies are funding this. Corporate CapEx. capital expenditures. The major players, we're talking NVIDIA, Microsoft, Google, Meta, Amazon, they are funding their massive investments.
Okay.
Things like building new factories, buying billions in chips, constructing huge data centers,
Yeah.
primarily using their own cash.
Their own cash.
Yeah.
Not borrowing heavily.
Largely, yes. These companies are sitting on hundreds of billions of dollars in liquid cash reserves. They are not, for the most part, relying on external leverage or taking out huge loans specifically for their core AI development and infrastructure build-out. So at the big company level, the actual AI build-out itself has remarkably low debt risk backing it directly.
That's actually a huge difference from previous tech booms, isn't it? Where companies were often highly leveraged to fuel growth.
A massive difference. Think back to the dot-com era, for example.
Mhm.
So the companies themselves, the big ones driving this, they appear fiscally very sound, sitting on these enormous cash piles. Their core investments aren't primarily supported by borrowed money.
Okay, if that's the case, where does the structural debt concern really come from then, if the companies are solid?
The real potential systemic danger lies not at the corporate level, but in market leverage. That means investors, individuals, hedge funds, etc., using debt, using margin accounts to buy the shares.
Ah, borrowing money to chase the rising stock prices.
Exactly. That creates a potentially fragile market dynamic. Because if prices fall sharply, those leveraged investors face margin calls. Their brokers demand more cash, or they're forced to sell. And that forced selling creates a cascading effect, pushing prices down further, triggering more margin calls. That's how market crashes really accelerate and amplify volatility.
Right, the classic downward spiral. So how much of that is happening now in AI stocks?
Well, according to Mookie Tenenbaum's data and analysis, the overall leverage level specifically for buying these high-value AI-related stocks is currently surprisingly low. He estimates it's hovering around just 1 to 2% globally.
Only 1 to 2%. That seems really low compared to history.
It is remarkably low. If you put it in historical context, think about past crises, the 2008 financial crisis, obviously, or even the European debt crisis market turmoil around 2011. Back then, the structural leverage across major asset classes was often much higher, maybe in the 5 to 10% range, sometimes even more in specific pockets. So current debt levels directly tied to AI stocks seem nowhere near those dangerous, structurally unsound conditions.
So the risk of a widespread collapse triggered by leverage in AI stocks is low right now.
The immediate structural risk appears low, yes. Now, could increased investor leverage become a danger if prices continue this meteoric rise for several more years? Absolutely, that's something to watch. But the risk of a market-wide debt collapse directly caused by AI valuation leverage right now. Mookie Tenenbaum stresses this point. It seems exceptionally low. The financial infrastructure supporting these specific companies looks robust today.
Okay, so the system-wide risk from leverage seems contained for now. But what about the risk to the individual? We should probably circle back to that classic piece of financial advice.
Yeah, definitely. A core message here, maybe the most practical one for you, the individual investor listening, it just circles back to that timeless truth. The risk of using too much personal leverage, getting that dreaded margin call, is a critical danger. Why? Because leverage completely eliminates your control over your own time horizon.
That's the killer, isn't it?
It really is.
Yeah.
Think about it this way. If you bought shares with your own cash, you can afford to wait out that potential 18-month volatility Mookie Tenenbaum basically guarantees is coming at some point. You can ride it out. But if you're leveraged and the stock drops hard, you might be forced to sell at the absolute bottom because your broker calls your loan and demands repayment now.
Wiping out your chance to recover. Exactly. You've lost the single most important advantage the long-term investor has: time. And that danger exists completely independently of whether AI ultimately succeeds or fails. It's purely a failure of personal risk management using too much debt.
Sound advice. Avoid leverage on volatile assets you plan to hold long-term.
Always. Okay, let's move to the final headwind. Threat number 4. Regulatory and structural rigidities. This sounds like it covers a lot. Government stepping in, maybe old labor laws getting in the way, environmental concerns, often driven by maybe specific political agendas or just legislatures struggling to keep up with the tech.
Yeah, this bucket is about friction caused by human systems, basically. And this is where we see some really concrete examples of, well, arguably self-sabotage in some regions. Mookie Tenenbaum uses Europe as the perfect current example of how well-meaning perhaps, but ultimately overreaching regulation can practically stifle AI development. It can essentially kill off regional innovation before it even gets started.
How so? What did Europe do that was so detrimental in his view?
Well, Europe passed landmark AI legislation. the AI Act. It's arguably the most comprehensive and stringent set of AI rules globally. But Tenenbaum argues the approach was fundamentally flawed, at least in its initial demanding stages. It risked killing its own AI ambitions by demanding things like deep access to the underlying intelligence, the generation mechanisms of the AI models, sometimes requiring access to proprietary model weights or detailed explanations of internal operations.
Isn't that transparency good?
In theory, yes. But the problem is, due to the complex, sometimes black box nature of these huge AI models, not even the engineers who built them can fully explain how they arrive at every specific output in traditional legalistic terms.
Ah, so they're trying to regulate something that's technologically outpacing the legislative framework.
Precisely. They were trying to impose old models of oversight onto a technology that operates differently, demanding blueprints for something that learns and evolves in ways we don't fully map.
Okay, so what were the immediate practical consequences of that stringent approach? Did it actually stop things?
According to Tenenbaum, the consequence has been significant technological lag and even some capital flight or avoidance. Many core, cutting-edge AI features that are readily available elsewhere, particularly the US, are currently blocked or heavily restricted in Europe. He notes examples where, even in tech-savvy countries like France, users sometimes need to use a VPN, a virtual private network, just to access certain advanced AI features that are commonplace elsewhere.
Really, using VPNs to get around local AI blocks.
Apparently so, for some specific functionalities. And this dynamic forces major AI companies, the innovators, into a tough spot. They either have to significantly redesign their products for the EU, relocate their cutting-edge R&D, or simply withhold their most advanced models and features from the entire EU market.
Which guarantees Europe falls behind technologically.
That's Tenenbaum's conclusion. A massive economic power risks falling behind because its regulatory approach, however well-intentioned regarding safety, ended up being too restrictive for the pace of innovation. And this leads to his broader point about the ultimate effectiveness of regulation for AI. Mookie Tenenbaum questions the very limits of government control over this kind of rapidly advancing tech. He suggests that once AI becomes sufficiently advanced and widely distributed, maybe within the next 2 to 3 years, it might become technologically irregulable.
Irregulable, meaning governments just can't control it anymore.
Effectively, yeah. Trying to regulate it at that point might be like trying to regulate, I don't know, the flow of information on the internet was 20 years ago. You can try, but the tech finds ways around it. Therefore, he believes the only geopolitical player whose regulation truly matters for the global trajectory in the long run is the U.S., simply because that's the current epicenter of development and investment.
And the U.S. stance has been less restrictive.
Generally, yes. Both the current and previous U.S. administrations have largely avoided severe innovation-stifling restrictions, focusing more on frameworks and safety testing. So Tenenbaum argues the global derailment threat from regulation is low, even if specific regions like Europe create localized headwinds for themselves.
Okay, so that's regulation of the AI code itself. What about those other rigidities, things like labor laws or energy use?
Right, those are also part of this fourth threat category. You see clear examples of potential rigidity in labor markets. Europe, for instance, might try to pass further laws explicitly banning companies from firing and replacing large numbers of employees with AI, citing social cohesion and labor protection.
Which sounds reasonable from a worker's perspective.
Absolutely understandable from a social policy perspective, aiming to protect jobs in the short term. However, Mookie Tenenbaum argues that such rigid restrictions will inevitably hurt those local economies in the longer run. They'll significantly restrict the speed of development and productivity gains compared to economies that allow AI to automate tasks and improve efficiency more freely. It creates a difficult trade-off: short-term job security versus long-term economic dynamism and competitiveness.
A really tough balancing act. What about resources like energy? AI uses a ton of power.
Yeah, the regulation of resources is also relevant. Could a U.S. state, for example, block the extraction of essential raw materials needed for chips? Or could environmental regulations severely limit the massive energy consumption required for AI data centers? These are possible friction points. But again, Tenenbaum suggests these are only serious threats to the global AI revolution if they happen at a large scale, particularly a national scale within the U.S. Any localized economy or region adopting very strict restrictions on energy or resources for AI will likely just see its own development slow down drastically, and the capital investment will simply flow elsewhere to places with fewer constraints.
Hmm. This raises a pretty sobering thought, one mentioned in the source material. Will all these regulatory differences, some places embracing AI, others restricting it, will they dramatically increase global inequality? It sounds like we could be building a new, very stark digital divide between nations.
It's a major concern, and Mookie Tenenbaum addresses it with a view that's actually quite nuanced and maybe surprisingly optimistic for many nations. He argues that most countries, the ones that choose to cooperate and integrate with the U.S.-led AI ecosystem, will actually develop more rapidly thanks to AI.
How so? Wouldn't the US just dominate?
His argument is that the technology, the tools, the productivity gains will be shared and leveraged globally, lifting many boats, assuming cooperation. The countries that will inevitably fall behind are those that actively impede AI development within their borders, maybe due to political hostility, excessive regulation, or trying to build their own isolated systems. He specifically mentions regimes like potentially Russia, China, or Iran facing this risk, finding themselves technologically isolated if they don't integrate.
So, cooperation is key to benefiting.
That seems to be his view. But he goes further and proposes a really provocative potential social benefit from AI related to political freedom.
Oh, how does AI link to political freedom?
Well, he draws a historical comparison. Think about past dictatorships. He mentions examples like apartheid South Africa or the former Soviet Union. These regimes had to expend massive resources to physically hide outside developments from their own people. They strictly limited access to foreign television, uncensored news, later the internet, anything that showed citizens a potentially better or freer life elsewhere. Controlling information was key to controlling the population.
Right, keep people in the dark.
Exactly. Tenenbaum suggests that highly advanced, globally accessible, and potentially distributed AI might make it virtually impossible for controlled regimes to hide the sheer volume of information, the progress, the opportunities available outside their borders. This constant, inexorable leakage of truth about the outside world, powered by AI generating and disseminating information, it could potentially lead to greater social awareness, greater demands for accountability, maybe even greater political freedom within those countries over time.
Because the propaganda just can't compete with the reality AI reveals.
That's the provocative idea. The dictator's ability to control the narrative gets fundamentally undermined when AI can instantly show citizens what life is like elsewhere or analyze state claims against real-world data.
Wow. That's a profound thought that the very technology driving massive economic shifts might also unintentionally perhaps become a powerful engine for social and political liberty by breaking information monopolies. Okay, let's try to synthesize all this. We've covered four major headwinds: physical threats like supply chain concentration, political threats dominated by Taiwan but also local regulation, and financial threats, mainly around leverage concerns. Bringing it all together, what's the ultimate viability assessment from Mookie Tenenbaum's perspective? Is this AI revolution truly vulnerable? Could it be stopped entirely by these headwinds?
Stopped entirely. Absolutely not, in his view. The threats are real, he emphasizes that, but Mookie Tenenbaum sees them as fundamentally temporal. They will cause serious turbulence, significant volatility, but not ultimate destruction of the trend. He actually puts some probabilities on it, which is interesting. He assigns roughly a 50% chance that some combination of these issues, a major supply chain break, a severe trade dispute, maybe highly restrictive regulation in a key area, will occur in the next few years. So problems are likely.
50% chance of significant disruption. That's high.
It is. And furthermore, he assigns about a 30% chance that the resulting market delays and regulatory friction from such an event will be prolonged, lasting for several months. But crucially, and this is key to his outlook, he sees virtually no possibility of these delays lasting more than 18 months.
An 18-month maximum delay. Why such a specific ceiling?
His reasoning comes down to the sheer inexorable nature of the technology itself. Once a vastly superior technology like AI arrives and proves its economic worth, it cannot be uninvented or suppressed for long. He uses the analogy of the shift from gaslight to electricity. Once electricity arrives and demonstrated its overwhelming economic and practical advantages, the transition became unstoppable. Sure, there were regulatory hurdles, supply issues, old industries fighting back, but the world simply found ways to bypass the obstacles because the financial and societal imperative was just too strong.
So AI is like electricity, too powerful and advantageous to be held back for long, even by major shocks.
That's the core of his argument. The world will adapt, reroute supply chains, innovate around regulations because the pull towards AI's capabilities is too immense to resist indefinitely. That 18-month figure represents the plausible maximum time it might take to overcome a major but ultimately temporary obstacle.
Okay, that technological certainty, even with likely disruptions, provides a very clear framework for thinking about risk. So, what does that mean practically? For you, the investor listening right now, who has to navigate these potentially very volatile markets with this 18-month disruption possibility hanging out there.
Right. Practically, the message is caution is definitely needed in the short term because these predicted setbacks, when they happen, and he thinks they likely will cause major market volatility, we could see sharp, sudden drops in stock prices, potentially 20% or even more, even for the big market leaders. It will feel scary when it happens. So the recommended investment strategy that Mookie Tenenbaum outlines is very pragmatic, really threefold, and it's designed specifically to help investors weather these almost guaranteed bumps in the road.
Okay, what are the three pillars?
1. Adopt a long-term focus. Seems obvious, but it's critical here. Investment success in a foundational technology shift like AI is hugely improved by having a genuinely long-term view. Ideally, think 5 years or more. That patience is what allows you to ride out those inevitable, maybe even 18-month-long shocks. On a 5-year chart, even a big dip like that starts to look like a blip.
Right, time horizon is everything. What's number two?
2. Focus on the avenues, not the side streets. This is about stock selection. Invest primarily in the large, established companies that are financially sound, the ones Tenenbaum calls the avenues. These are your giants. Microsoft, Google, Nvidia, maybe Amazon, the ones with deep cash reserves. They have the financial strength to endure major supply chain shocks, absorb regulatory delays, and generally survive any temporary market downturn. The advice is generally to avoid the smaller, potentially highly leveraged startups, the side streets, which might seem exciting but could easily be wiped out by a sharp 18-month correction or funding freeze.
Ugh,
Stick to quality.
makes sense. Focus on the survivors. And the third pillar.
The third pillar, and we discussed this in detail earlier, is avoid leverage. Absolutely, do not use debt, do not use margin to purchase these long-term assets, even if the short-term returns look incredibly tempting. As we said, leverage completely removes your control over time. It forces you to potentially liquidate your positions at exactly the worst moment, the point of maximum volatility and panic, which is precisely the moment Mookie Tenenbaum suggests the disciplined long-term investor should actually be considering buying, not selling. So no leverage.
Okay, so the overall consensus, at least according to the deep and detailed analysis presented by Mookie Tenenbaum, seems clear. While these four headwinds, the physical supply chains, the geopolitical tensions, the financial market structure, and the regulatory hurdles will almost certainly cause significant market volatility and temporary setbacks. The underlying technology itself is viewed as fundamentally unstoppable, and the major, cash-rich players, the avenues, will likely continue to drive the revolution forward after weathering each inevitable delay. Is that a fair summary?
I think that captures his core message perfectly. Expect turbulence, prepare for it, but don't mistake it for the end of the journey. And maybe a final thought to leave people with. We spent this whole deep dive talking about the risks of states and regulators trying, perhaps futilely, to control AI. We established that Mookie Tenenbaum believes this technology will likely reach a point, maybe soon, where it becomes technologically irregulable, uncontrollable by conventional means. So if that development continues unchecked and we do reach that state, what happens then? What happens when humanity potentially loses the ability to legislate or effectively govern the technology that is increasingly guiding its future? How does that ultimate loss of technological control fundamentally and perhaps irrevocably change the relationship between society, government, and, well, the machine itself?
That is a question that definitely moves beyond just economics and deep into philosophy, isn't it? And one it feels like we'll all be grappling with much sooner than we think. Thank you for joining us for this deep dive into the four major risks facing the AI revolution, drawing on Mookie Tenenbaum's insights. We really hope this knowledge helps you navigate this complex, incredibly fast-moving industry with a clearer view of both the challenges ahead and what seem like the guaranteed long-term prospects.